Hello, good morning and welcome to the brand new edition of the newspaper show right here on ET Now. I'm Cheryl D'Souza and I'll take you to the top headlines as they're on the Economic Times as well as the Times of India. So let's get started with the top headlines as they're on the ET this morning. And first up is after ban on 59 Chinese apps, you have 275 more on the radar. That is the top headline that's there on the Economic Times. Moving on, you have government to write a code for apps to run on. Moving on, you have Huawei that slashes India's revenue target by 50%. You have Brooklyn, that is Brookfield, I beg your pardon. Brookfield gears up for $500 to $700 million REIT issue. Time for Z to change, that's the word coming in from Punit Goenka. Aditya Puri sells HDFC Bank shares worth 843 crore rupees. You have RBI questions Axis Bank on Max Life deal terms. India looks to reset FTAs and may exit fruitless deals. You have COVID hazards far from over. That's the word coming in from Prime Minister Narendra Modi in Mann Ki Baat. And Patel saying that he quit as government undermined authority. Viral Acharya saying that Urjit Patel quit as government undermined autonomy. That's the word coming in from that exclusive interview as well. Now let me shift focus from the top headlines that's there on the Economic Times to the market headlines that's there in the ET. And first up is street valuing RIL in line with tech giants. Moving in on for Alembic to raise about $150 to $200 million via stake sale. You have Asian Paints that's upgraded despite weak Q1 show. RBI stability report silent on bank frauds. And Trump signs 4 executive orders on drug prices. And from market headline to corporate headline, and first up it is consumer services sector's cushion Q1 show. You have Pond's White Beauty goes for a color correction. Foods claiming to boost immunity under FSSAI lenses. India Inc. seeks public infra investment boost. Small cities help beauty companies get sheen back. All right, and those are the top headlines that's there on the Economic Times for you this morning. But let me shift focus on to the top headline that's there in the ET this morning. And here you go. This is the story that's there on the front pages. Right on the top of Economic Times, I'll read it directly off the paper for you. And some after ban on 59 Chinese applications, 275 more on the radar. Some red flag due to security reasons, others on account of data sharing and privacy concern. The list actually includes Tencent-backed gaming app PUBG, your Xiaomi's Zili, as well as AliExpress from Alibaba Group. So India has drawn up a list of 275 Chinese applications that it will examine for any violation of national security and user privacy, signaling heightened security, scrutiny, and the possibility of more Chinese internet companies being banned in the nation. This is according to people aware of the development that they told Economic Times. This follows the high-profile ban of 59 Chinese applications last month, including short video app TikTok, amid simmering global geopolitical tensions between the two Asian giants. So the list that is reviewed by Economic Times includes gaming app PUBG, backed by China's most valuable internet major Tencent. You have Zili by Xiaomi, AliExpress by Alibaba, as well as application Reso and YouLike from ByteDance. So the government may ban all or some or none from the list. This is as per sources that they've told Economic Times. So there you go. Government drawing up some more list of Chinese applications that's under scrutiny. Also, the names include like PUBG, you have Zili, you have AliExpress as well, that's there on the radar of the government. So the government, the sources are saying that the government may ban all or some or none from that list. Now let me shift focus to another story that's there on the page 7 of Economic Times, and this is pertaining to Alibaba, and that is pertaining to Jack Ma. So let me talk about the story. So Jack Ma and Alibaba have been actually summoned by Gurugram court on ex-staff complaint. An Indian court has summoned Alibaba and his founder Jack Ma in a case in which a former employee in India says that he was wrongfully fired after objecting to what he saw as censorship and fake news on companies' applications. This is as per documents seen by Reuters. This is what Economic Times is quoting this particular article too. The case comes weeks after India cited security concerns in banning Alibaba's UC News and UC Browser and 57 other Chinese applications. So in the court filings dated July 20th and previously not reported, the former employee of Alibaba's UC Web, Pushpinder Singh Parmar, alleges that the company used to censor content seen as unfavorable to China, and its apps UC Browser and UC News showcased false news to cause social and political turmoil. So there you go, on back of this particular complaint coming in from a former employee of UC Web, Alibaba as well as Jack Ma have been summoned by Gurugram court. So this is an important development to keep an eye on. He's actually talking about censorship on particular some sort of news as well as coming in on these particular platforms. Now let's shift focus and let's talk about staying with Chinese telecom equipment maker Huawei has slashed its India's revenue target for 2020 by up to 50%. So Huawei is also laying off 60 to 70% of staff, excluding those in research and development and the global service center. So this is another story that's coming in on Economic Times, and there you go on your screens, you can see it. Huawei has slashed its India revenue target by about 50%. You have Huawei laying off 60 to 70% staff as demand has plunged. Huawei now targeting about $350 to $500 million revenue for 2020, is not expecting any new business coming in from Airtel as well as Vodafone Idea. So there you go, another impact that you can see on Huawei, a Chinese telecom equipment maker. Now let's shift focus to another story that's there on the page 1 of Economic Times, and this is about according to a new book that is coming in from the former RBI Deputy Governor, that is Viral Acharya, and he's written a new book, and in that there are some quotes coming in. So let me just read it directly off the paper for you. And Viral Acharya is saying that Urjit Patel quit as government undermined RBI's autonomy. Also, this is as per Viral Acharya's new book. Urjit Patel quit prematurely as RBI governor did because of attempts to undermine the institution's autonomy, according to the new book by former Deputy Governor Viral Acharya. He says in his book, and I quote, "A complete degeneration into excessive monetary and credit stimulus that had caused the Indian financial sector to lose its stability in just the previous decade has been rendered difficult," Acharya writes in the preface to a quest for restoring financial stability in India. There's another quote coming in from Viral Acharya, and I say, and I quote him in this, "I didn't strike compromises on what really mattered for restoring the financial stability, neither did the governors nor with the government. At times it wasn't easy, but I continue to believe that it was worth fighting for." This is the quote coming in from former RBI Deputy Governor Viral Acharya. Now let me shift focus on to some news coming in from the banking space, and this is there on the ET page 5. And Puri sells 95% of his stake in HDFC Bank. So how much did he sell, and what is the reason for this? I'm joined by my colleague Varun to take me through the details. Varun, good morning. And Puri has sold some of his stake in HDFC Bank, look like it.
Yeah, good morning, Cheryl. It is definitely not good news for HDFC Bank shareholders, because let's remember the bank stock has just recovered post the Q1 result. We were hovering at like 800, 900,000. Then after the Q1 number, people saw 9% moratorium. They saw HDFC Bank credit is still growing. They saw Aditya Puri's commentary about the next successor at HDFC Bank being someone who's worked with the bank for 25 years. So people were like, okay, fine, HDFC Bank is okay, no issues here. And then now Aditya Puri, while he is retiring, his term is coming to an end and he's an elderly gentleman. So nothing wrong with an elderly gentleman selling his shares and taking money off the table for his retirement. But the timing is not very positive because what happened over the weekend, as I'm sure you're also aware, RBI came with a warning that 14% of loans could go bad from the banking system. Now, if RBI is saying that and Aditya Puri has sold shares on the Friday before RBI said that, that's definitely going to create some panic, right? Especially because HDFC shares are now trading within 20% of the 52-week high. So they've almost fully recovered. And at this point, people might just see that, he tried to do a opportunistic thing. So it'll be interesting to see how the market reacts. Nothing wrong, I repeat, with Aditya Puri selling his shares. Nothing wrong on the compliance side. It's perfectly within every single norm. And as he's retiring, it's fine. But just the timing right now, given all the warnings that are coming from RBI, might spook investors a little bit.
All right. Thank you, Varun, for taking us through the details of that important development coming in with pertaining to HDFC Bank. But let's move on and let's talk about another bank. And this is Axis Bank. And this is the story that's there right here on the front page of Economic Times. And I'll read the story for you. And that is RBI questions Axis Bank on Max Life deal terms, wants to know the deal structure and why bank is acquiring over 20%. The Reserve Bank of India has questioned Axis Bank about the terms of the proposed deal to form an insurance joint venture with Max Financial by acquiring a total 30% stake in its subsidiary, that is Max Life subsidiary, Max Financial. This is as per sources to Economic Times. This follows the insurance regulator raising queries about a clause that allows Axis Bank to exit the venture at a fixed price and the companies agreeing to make changes accordingly. So RBI wants to know how the deal will be structured and why the lender is acquiring more than 20% stake in the life insurance company. So there you go. Another important story that to keep our eyes out on, and this is RBI questioning Axis Bank on Max Life deal terms. Definitely need to watch out how the stock of Axis Bank as well as Max Financial trades in today's session. Let me shift now to another story that's there in Economic Times page 7, and this is about India looking to reset the FTAs. They may also exit fruitless deals. That's the story that is there in the Economic Times. I'll read it directly off the paper for you. So India looks to reset FTAs, may exit fruitless deals, renewed focus on trade agreements with key markets, that is the United States, EU as well as UK. So India is eyeing a major reset of its free trade agreements, including exiting those that have brought few tangible benefits to the country and have also instead ended up hurting the domestic industry. That's as per government officials. All options are on the table. There is a view that if any trade agreement has not worked out as expected, we should also look at exiting such a deal. This is as per a government official. They're also saying that the final call on the future strategy for such arrangements would be taken at the highest level. So most trading agreements have a clause for a review or an exit. So also this is what is the latest that is coming in, from that is government is looking to reset FTAs, may also exit the ones that are fruitless, that is as per what the government sources is saying. Also, 4 working groups have been set up after PM's review. New Delhi could look at even exiting disadvantageous ones. New strategy to be formulated for forging such a deal. So this is an important story that is coming in on with regards to the FTAs. Now let's shift focus on to Times of India and a story that's there in the business page of Times of India, that is page 11, and this is talking about Biani as well as Ambani on the future deal and what is the latest coming in on that front. I'm joined by my colleague Winnie. Winnie, good morning, and what is the latest that's coming in on this particular deal front?
Cheryl, good morning. And like we know that Reliance is in talks with Future Group to buy its retail business. So they did have some concerns on the valuation side of the future retail business, which they're planning to take over. But now seems like, both the companies have and both the promoters have managed to settle these differences and terms which they wanted. They have negotiated it. And now seems like they have taken a step forward and they're in the talks to enter the final stage of the discussion to take over the business. So, while there were differences, that took a lot of time for, to settle down. And that is why the deal took a bit longer than what it was expected. But this shows, that Reliance is entering the business and they are ready to take over and dominate the India's retail sector, while Future Group also has other overall 6 listed companies. And Reliance is looking to buy only Future Retail Group. So Future has been in a lot of pressure due to liquidity pressures. Their debt is very high. So this is coming in as a positive sign for Future Retail, especially if, Reliance ends up buying it, they will get some liquidity that will ease it out, especially when you're seeing rating agencies like Fitch also cutting reducing their stance on the company and taking it to the negative stance for Future Retail. So this may come in at some relief, at least for Future Retail. And, we'll keep a close eye on how actually this deal goes forward and when do we actually see the deal ending by.
All right, thank you, Vinny, for getting us the latest on that particular front. But now let's shift focus to page 2 of Economic Times, and this is with regards to Prime Minister Narendra Modi's Mann Ki Baat that he held yesterday. And Prime Minister Narendra Modi on Sunday said that the hazards of the COVID-19 pandemic were far from over and that it was spreading fast in several places. His statement comes amid a rising number of positive cases being recorded across the country daily. He said this, and I quote, that we need to be extra vigilant. We have to bear in mind that coronavirus is as fatal today as it was in the beginning. That's why we have to be fully cautious. This is Prime Minister Narendra Modi saying in his monthly Mann Ki Baat radio address. He also said, and I quote, that the loss of even one life is saddening, but India has also succeeded in saving the lives of millions of her people. Wearing a mask, using a gamcha or a light towel to cover, 2-yard distancing, frequently washing hands, avoiding spitting anywhere, taking full care of hygiene and sanitation. These are the weapons to protect us from coronavirus. This is the word coming in from Prime Minister Narendra Modi in his Mann Ki Baat address, saying that corona is as fatal today as it was in the beginning. We have to be fully cautious. That is the word coming in from Prime Minister Narendra Modi. Now let me shift focus on to page 1 story that's there, and that is Brookfield is geared up for a $500 to $700 million of realty trust issue. To talk more on this, I'm joined by my colleague Vivek to talk on this. But before I'm joined by Vivek, I'll basically take you through what are the details of this particular details of this particular story. So Brookfield is geared up for $500 to $700 million realty trust issue. Process to monetize assets via REIT listing already on. The proposed REIT is expected to be listed by March end, and at $700 million, this would be India's largest REIT issue yet. This is the story coming in on page 1 of Economic Times, saying that the Brookfield is geared up for a realty trust issue, that is a REIT otherwise. Let me now shift focus on to a story that's there on your Times of India, and it is there on Times of India page 11. Just give me a moment while I get you that page on and talk about that particular story. And Goldman Sachs this time around is talking about India e-commerce space, and India's e-commerce industry is expected to reach $99 billion in size when online e-commerce penetration will more than double to almost 11%. The growth rate for the Indian industry in India for the next 4 years would surpass the same of the established economies like United States, China, UK and Brazil. This is as per Goldman Sachs review of the e-commerce market. So definitely Goldman Sachs saying that India's e-commerce share is set to double to 11% by 2024. He's saying that they are also saying, I beg your pardon, Goldman Sachs also saying the e-commerce is expected to register a growth of over 18% for the current year, but estimates for 2021 and 2022 show a year-on-year growth rate of over 33% and 28% respectively. So there you go. This is coming in from the Goldman Sachs report on India's e-commerce industry, where they're saying the share is set to double to 11% by 2024. Now let me shift focus on to a story that's there on the page 1 of Economic Times, and that is talking about the RBI stability report, financial stability report that actually came out on Friday. And in that, basically, what it's talking about is that the RBI has questioned the stock market's exuberance, and also warned about a spike in bad loans, and signaled a withdrawal of revival measures introduced to cope with COVID-19 crisis when economy returns to normal. So to talk more on this and what exactly does the RBI Financial Stability Report talk about, I'm joined by my colleague Maithili Busnalmat, who's explaining the details of this.
The Reserve Bank of India's Financial Stability Report released this evening contains some rather alarming numbers. It says that the asset quality of banks are deteriorated very sharply, and even in the baseline scenario, gross non-performing assets of the entire banking sector are likely to increase from 8.5% in March 2020 to as much as 12.5% by March 2021. And if in case the situation worsens, and in the worst case scenario, we could see these gross NPAs go up to as much as 14.7%. Now that is a very alarming number, because so far, while we knew that non-performing assets are likely to rise, we did not have a number. And this is a number which the RBI, the first time that RBI has put a number to it. So it warns of the deteriorating asset quality. It says that extreme risk aversion, and it stresses the importance again of financial stability. Extreme risk aversion is likely to impact growth going forward. So all in all, not a very happy picture at all presented in the FSR, particularly because if banks are going to be impacted so adversely, particularly because of moratorium which it warns is going to hit the profitability of these banks. Remember that the bulk of the banking sector is in the public sector, and anything that impacts the profitability of these banks is also going to impact the dividend payout to government. The report as it is warns of deteriorating central government finances, and add to that we have another whammy coming by way of deteriorating profitability of public sector banks. So it is a timely warning. It warns about growing NPAs, deterioration in asset quality, the need to beef up the capital, and also about the dangers of government revenues falling short. So a timely warning. Whether this will serve the purpose remains to be seen. It all depends on how the economy recovers post-COVID.